So why is it impossible to predict market turning points? This is backed by the efficient market hypothesis. When it comes to trading, one of the biggest challenges is predicting market turning points. This is what everyone else is trying to do out there, which is basically the exact moment when prices will reverse or continue and go either in the opposite direction or continue the trend. So it doesn't really matter if you're dealing with stocks, forex, crypto, or any other financial markets or instruments. Trying to pinpoint those moments can feel like trying to predict the weather a whole month in advance. So why is it so difficult, guys? Let me tell you, it's not just difficult, it is practically impossible. And today we're going to dive into why this is the case. And I'll be backing up this with something called the efficient market hypothesis, or the EMH for short. I would also follow this video with a quick update on my trades on the Dow Jones, which currently is giving me 1-to-30 risk to reward ratio. And I would like to just mix the theory with the practice, because I'm talking about the efficient market hypothesis now, but I will also want to show you a trade for which I didn't try to do any market predictions. I let the market decide if this trade would turn out to be a profitable or a losing trade, and this is how it turned out. By not trying to predict the market direction, I managed to get into a trade which is a 1-to-30 risk to reward ratio. So what is the efficient market hypothesis? In simple terms, the efficient market hypothesis is the idea that all available information is already reflected in the price of a security. So stocks, for example, are always priced fairly based on the current data that is available to everyone, and all new information, for instance, like earning reports, political changes, even a tweet from a CEO, gets absorbed into the price almost immediately. That's why it's close to impossible to act on this information. And to summarize it, there are 3 levels of the EMH. So we have the weak form, the semi-strong form, and the strong form. Let's stop on the first form of the efficient market hypothesis, the weak form. The weak form, it states that the past price movements and volumes do not affect the future prices. So technical analysis is essentially useless. Contrary to what everyone else is trying to teach you out there, that by studying technical analysis you can become profitable. This is apparently not the case according to the theory, and I strongly back this. The second form is the semi-strong form, which basically states that all publicly available information is priced in. This means that the fundamental analysis won't give you an edge either. As the majority of you are well aware, my day trading strategy doesn't incorporate any fundamental analysis, because I simply don't think that this can help you to predict day-to-day markets durations. And the third form is the strong form, which tells you that even insider information is already reflected in the prices, which means that no one can consistently outperform the market. So what does this mean to you as a trader? If markets are efficient, trying to time the perfect turning points or the perfect continuation point based on charts, patterns, or even deep research is basically futile. The price you see is already the right price, guys. Predicting market turning points is impossible. Let's break down why this makes it so difficult to predict the market turning points. Reason number 1 is markets respond to news immediately. Let's say there is a huge piece of news like the change of interest rates, guys. You might think that that's a great time to predict a market reversal, right? But here is the problem. Everyone else knows already about this news too. This is already priced in immediately. The EMH suggests that unless you have access to private, non-public information, which by the way is illegal, you're always working with the same data as everyone else. And by the time you react to it, the market has already moved, and it probably moved miles away. Reason number 2, or noise versus the signal. Another challenge is basically distinguishing between real signals and a market turning point, which is considered to be a mere noise. For example, you might think that you're seeing a trend that is developing, but it could be just a short-term fluctuation or a random price movement. According to the efficient market hypothesis, the vast majority of short-term price changes are random and unpredictable. So when you think you're catching a turning point, it might just be noise tricking you. Now, reason number 3, guys, herd behavior and market sentiment. Even if you can spot a turning point, there is the issue with the market sentiment. In reality, markets don't always move based on logic. Herd behavior can cause irrational spikes or crashes, and also emotions can influence the price, emotions like fear and greed. So since emotions are not quantifiable or consistent, they're extremely hard to predict, and the EMH supports this by suggesting that these emotional reactions are already factored into the prices. Now about the data. Consistently outperforming the market is very, very rare. In fact, it's more rare than you can actually think about that. Data from numerous studies shows that even the most well-known fund managers rarely outperform the market consistently over time. For example, over a 15-year period, about 92% of large cap fund managers underperform the S&P 500 index. So even the pros with advanced algorithms and insider knowledge, they can't consistently predict turning points. So what does this tell the average trader, guys? So this tells you at least that you should not be trying to outperform the market. This leaves you two options and leaves me as well as a trader. So one option is investing all of your money in an ETF or some vehicle that actually tracks the performance of the major indices. The other option is trying to find a way, especially if you're day trading, a way that does not involve market predictions inside. This is exactly what I'm trying to achieve with my day trading strategy. And by following those rules, let me show you the last trade I have taken, which is a Dow Jones trade. What is the performance of this trade by not trying to predict the market direction? Again, guys, it's very important. I want to put the emphasis here that I was not trying to predict, come up with a market direction. My whole idea was to get into a risk-free trade, and then from there onwards, let the market decide if this trade would turn out to be a break-even trade or a very profitable trade. So let's have a look where the market has taken us. All right, guys, so here is an update on the Dow trade, which I took yesterday. It's absolutely phenomenal. We are making 1 to 31 risk to reward ratio. And I was actually having my trade up here just before the CPI data. I was making very, very conservative one to, even less than 1 to 10. And then the CPI data completely made this trade. So currently it's 1 to 31 risk to reward ratio, and it's still going lower. As you can see, there is a very high chance that we might reach for the next major demand area, and this would be right here. So this is, what is it, another 1,500 points, which is a huge number, guys. So I would see if I will be closing this trade there. Currently it's 1 to 31 ratio. I just wanted to give you an update, and then I will decide if the price starts reversing towards this level here. I might decide to close the trade, but still I'm still running this trade. Cheers. See you in the next video, guys.